Yeah, so we got a question on Olympia Financial. They stated that it's underfollowed, profitable Canadian financial company with a high dividend, well covered by income, but terrible liquidity. It's mostly ignored even by Keystone. I will do a slight correction on that. Is we did actually highlight it in our 2024 Dividend All Stars. We had a small highlight on that. Not a significant highlight, but we did. We do know it existed before this. So, Olympia Financial Group, symbol OLY on the TSX, the Canadian Financial Services Company. The company breaks its operations into investment account services, private health services, currency and global payments, exempt edge division, corporate and shareholder services, as well as they have a corporate division as well. Then, investment account services, which manages over 10 billion assets, provides services for registered accounts like TFSAs, RSSBs, and so on. It with a focus on exempt market securities, which are just private companies, really, not non-listed companies, so non-exchange traded companies, as well as arm's length mortgages, which is the really differentiator. Most companies in financial services generally focus on public companies, but they focus on private companies and really allow smaller investors to gain access to them. As well, I will mention the company receives interest on the cash portion of these accounts, as it makes up a large portion of their revenue. The stock has performed well over the past year, up 16% to $100 flat a share, a nice round number, and a $242 million market cap with a nice dividend yield of 7.2%. Diving into the Q1 income statement, service revenue was up 3.5% to $12.3 million. Trust income, which is derived from the combination of the interest rate and the trust size, with the cash in the trust side, rose 17% to $13.5 million, with the interest rate component being the major driving factor, resulting in total revenue growth of 9.4% to $25.8 million for the quarter. Net income grew 9.8% to $5.7 million. Effectively, net income grew in line with the total revenue growth, as there were no really massive shifts in operating expenses during the year. There was a slight uptick in administrative expenses, and that's happened the last few years, but not any significant change. EPS grew to $2.39 with no change in share count over the past year. So nice share structure as far as that goes. Shifting to the balance sheet, it appears to be strong. $25.1 million in cash, $3.6 million as a liability as a revolving credit facility, and another $900,000 or so in leases, resulting in just over $20 million in cash. However, though, I will point out the company does actually have a significant deferred revenue liability, and this relates to the annual registered plan services admin fees being received at the start of the year, so they receive the cash. They can't recognize the revenue yet, so it creates a liability, and that had occurred in previous years as well, so it's really just a quirk of the operations. It's not inherently bad or good. It's actually normally can be seen as a good thing as they get the cash up front. It's prepaid effectively, but it's something which you need to be aware of because it inflates the cash at the start of the year. And then, as you can see in the graph I have, it kind of goes down throughout the year. It trends down throughout the year. Q1, it will pop up, then it comes back down. And that's happened year over year. And there's obviously some noise in there, but it's a major driver in it. We can see this in the last quarter. When you compare it to year-end cash, it increased about $14 million that in the one quarter. So the balance sheet is by no means weak, but it's not as strong as you would just seeing that strong cash balance with really no debt, minor debt, I should say, compared to other companies where they may have a significant debt or a net debt position. I will want to focus on how important the high interest rate environment has been for Olympia. The company states its interest rate sensitivity for a 1% movement for the quarter would result in an increase of $2.04 million and a decrease in income of the same amount if the interest rates fall by 1%. Looking at the prime rate over time, which is what they borrow at, and that's what they quote, they don't actually give their effective interest rate of what they earned on the trust holdings. So I'll just use the prime as a graph it over time, and it's variable. So there we go. You can see we're at a 20-year high, and if we say drop 3% to roughly the pre-pandemic level, the company will lose $3 million in net income a quarter, which, if you recall, that is more than the $5.7 million total net income in the last quarter. So quite a bit of interest rate risk. Given the recent moves by the Bank of Canada to cut interest rates and the continued expected rates, if it were to fall back down to those pre-pandemic levels or even below that to 3% like it was during the 2010s, that could actually put the company into a net loss position given its current interest rate sensitivity, which those are their numbers, I should say. Whether or not there's normally some other movements or some offsetting movements, but I'm quoting their numbers, and it's not necessarily lost if it did drop 3%, but that's what they're stating at this time. Now, looking at the dividend, the company pays a 60-cent monthly dividend, or $7.20 annually, resulting in a nice yield of 7.2%. The dividend was raised substantially in 2023 from about 27 cents at the end of 2022 to the now 60 cents, so over doubling it during this time. And prior to that, they had a quite flat period, but they previously raised over time. Based off the most recent quarter, as well as the prior quarter was roughly about the same, bit lower. The most recent quarter, the payout ratio was 75% of net income, which is quite high after raising its dividend, but it's not absurd for a financial company either, but you do need to take notice of it once it's getting that high. It is something you need to be conscious of, as if earnings do start to drop, that can put the dividend at risk quite quickly. Shifting to a quick valuation, the company trades at 10 times earnings, or P of 10 times, as well as a 10 times cash flow over the past year. Given the recent growth, it would seem like it's undervalued, but I would like to note and emphasize this is primarily due to interest rates rising over the past couple of years, and now we're seeing the trend reverse. So going forward, I would not be surprised if earnings actually do start to decline, just given due to their interest rate sensitivity. So wrapping things up, if the interest rate stays steady, or the highest rate of interest rates that have been over the past year, it's been really driving the earnings. Continued, the company would likely be undervalued, but that's probably not the case given the macroeconomic backdrop. The company's really benefited handsomely from these higher interest rates, but that growth has not been seen in its services revenue at anywhere the same rate. During the last couple of years, admin expenses have also increased, so that's your employee cost effectively, at a higher rate than service revenue, so they're spending more on their employees at a higher rate growth than compared to their service revenue. And that's really what they have control, is their service revenue more than interest rate revenue. They can, of course, increase the trust cash amount and the oversized size of the trust asset, and that is something which they can do. But as they've stated in many of their news releases and management commentary over the past couple of years, it's almost all due to interest rate. I would expect the trust to be growing roughly in rate with the size of their service revenue growth at 3-4%, which would make sense. So Olympia net income could very well be in a worse place than what it was before the pandemic due to that. If the service revenue does not start to grow in the near future, which is higher admin costs. Further, the company does have a significant payout ratio during the last couple of quarters at the 60-cent monthly dividend. So if EPS contracts, the dividend could potentially be at risk getting cut back down to that lower rate. It did increase very quick, very substantially. Maybe they didn't want to they didn't have another effective use of cash, so they handed it out to shareholders, and they plan to reduce it when they need to. Some companies would do that. That is something I would look into it if I were to want to invest. But really, to summarize the bull case for Olympia, you need to have higher interest rates for longer to support that 7% dividend, and for it to allow the service revenue to grow over time at that low single-digit growth rate. Meanwhile, the bear case is really a dividend cut, lowering return, and it would likely cause the market to reprice the company, resulting in capital losses. So really, the trade-off doesn't seem appealing to me, given the current macroeconomic condition of we're in really a cycle of rate cuts now, and we're starting to see more expectations and higher expectations for cuts in the US, and as well as Canada continues to look to cut. So I really just pass on Olympia for now, as it is just so interest rate sensitive, and that other operations aren't growing at the same rate to make it appealing.
Yeah. I mean, like looking forward, like if interest rates decline, what could that forward, earnings multiple be? 13 times, 14 times, if we did see, earnings drop. Again, I'm sure we'd be able to, you know, actually do some napkin math basically just on what they provided by if there is, that 100 basis point move. But exactly that. It's interest rate sensitive. And if we see them come down, earnings are going to drop.
Yeah, and I'd agree that on the valuation, so 10 times, even if you were to take that 10 times multiple, relative to most stocks, that's fairly attractive. But, relative to most financial companies, like say the banks, they're mostly trading at less than 10 times, right? And you'd have the opportunity to get a much more diversified name that's actually less interest rate sensitive potentially. So
Yeah, and there's a smaller cap bank that we're recommending right now that has significantly higher growth path ahead of it that's actually trading at below the 10 times multiple as well. So Olympia, there's some pluses there, but it's always it's relative to what else you can buy in the financial sector as well. And there's some other names that we like right now ahead of that company.